Welcome to The Explainer. Today, we are unpacking Quanta Services, ticker PWR. We're going to decode their massive growth, their strategic positioning, and figure out exactly what is driving their incredible $100 billion valuation. To do this, we're putting PWR through the ultimate gauntlet, applying the classic investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, along with a deep dive into discounted cash flow models to see if it's actually a buy.
Let's start with a staggering number to set the stage. $48.5 billion. That is Quanta Services' record project backlog. Before we even unpack the nuts and bolts of what they do, just let that number sink in. For an investment analyst, that represents $48.5 billion of pure earnings visibility and guaranteed future free cash flow. I mean, this is exactly the kind of predictable revenue stream that value investors like Warren Buffett absolutely look for when evaluating a company's long-term staying power.
So how exactly does a company build a backlog that massive? Well, Quanta Services is the ultimate picks and shovels play. While everyone else is hyped up on the software side of AI, Quanta is out there doing the literal, physical work to build North America's critical energy and communications networks. Under the Warren Buffett lens, this creates a massive economic moat. Their highly specialized, unionized workforce and the essential physical nature of their grid modernization work, it prevents new competitors from just swooping in and stealing market share. They are the crews physically making our power-hungry world possible.
Here is our agenda for this explainer. Number 1, the $100 billion infrastructure giant. 2, smashing Q1 2026 expectations. 3, a record $48.5 billion backlog. 4, aggressive $1.7 billion M&A strategy. And 5, Wall Street's verdict on PWR.
Okay, let's dive into Section 1, the $100 billion infrastructure giant powering the grid.
Quanta Services is an absolute behemoth. We're talking about a market cap hovering right around $100 billion. They operate across electric power, renewables, and broadband markets, and this is fueled by an incredibly massive craft-skilled workforce of roughly 69,500 employees. If we apply the Peter Lynch framework here, given their sheer scale combined with double-digit growth, we'd classify them as a classic, fast-growing stalwart. But what truly stands out for the Buffett checklist is their financial consistency. They have a 9-year consecutive record of earnings per share growth and an incredibly strong return on equity. Their differentiated operating model relies heavily on this specialized labor force to deliver execution certainty for massive utility customers.
Moving right along to Section 2, smashing Q1 2026 expectations, the catalyst. Now, what's really interesting about these numbers is the sheer velocity of their growth. It's remarkable. Revenue jumped from $6.23 billion to $7.87 billion year over year. GAAP earnings per share rocketed from 96 cents to $1.45. And adjusted EPS? That surged over 50% from $1.78 to $2.68. They didn't just edge past consensus estimates, they completely blew them out of the water. Now, a Peter Lynch analysis would immediately require us to look at their PEG ratio, price to earnings divided by the growth rate, to see if these 20% plus year-over-year jumps across the board actually justify the stock's high current price tag.
A 26.3% year-over-year revenue jump for a company of this scale is frankly extraordinary. As Quanta CEO Duke Austin noted, this is a double-digit acceleration driven by the execution certainty their workforce delivers. From a valuation standpoint, this kind of top-line momentum forces analysts to revise their near-term free cash flow projections significantly upward in their base case discounted cash flow or DCF models. The momentum across their end markets is giving management the rock-solid confidence to raise their full-year guidance.
Section 3, a record $48.5 billion backlog. Visibility into the future.
Building on that momentum, management substantially raised their 2026 full-year outlook. They now expect consolidated revenues between $34.7 and $35.2 billion. Adjusted EBITDA is forecasted to hit somewhere between $3.49 and $3.65 billion, with adjusted EPS coming in between $13.55 and $14.25. For a strict value investor utilizing Benjamin Graham's defensive checklist, this massive backlog and raised guidance easily satisfy the criteria for both adequate size and phenomenal earnings stability. That $48.5 billion backlog, which, by the way, includes $26.2 billion in remaining performance obligations, provides an incredibly rare level of guaranteed future work.
So what's the actual catalyst behind this fast-growing backlog? It's the AI data center and renewable energy boom. We are seeing skyrocketing demand for the infrastructure required to power AI data centers and modernize the renewable energy grid. Quanta's management notes this represents a multi-billion-dollar opportunity per major customer.
When investment analysts build out their DCF models, these exact macro tailwinds, the absolute necessity of grid capacity for the artificial intelligence revolution, are what they use to justify assigning highly elevated terminal growth rates to the company.
Which brings us to Section 4, aggressive $1.7 billion M&A strategy, compounding growth.
To keep up with this monumental demand, Quanta is strategically buying up capabilities. Look at Step 1. They deployed roughly $1.7 billion across 3 acquisitions in the fourth quarter alone, picking up highly specialized companies. But here is the kicker in Step 2. Despite this aggressive spending spree, they maintained a leverage ratio below 2x. Warren Buffett would highly praise this capital allocation, as it perfectly satisfies his rule for manageable debt. Finally, Step 3 shows them investing between $500 and $700 million directly into their vertical supply chain for high-voltage transformers and breakers. Bringing these constrained components in-house actively widens their economic moat. It ensures schedule certainty that their competitors simply cannot match.
Alongside this aggressive M&A and supply chain integration, Quanta is actively returning cash to its investors. Their board recently authorized a $1 billion stock buyback plan, and they've consistently grown their dividend, recently raising it by 10%. A 10% dividend hike ticks another absolutely crucial box on Benjamin Graham's defensive checklist for a solid dividend record. Furthermore, that $1 billion buyback actively increases the owner earnings per share for existing investors, which is a core metric favored by Warren Buffett. It signals massive internal confidence from the management team.
Finally, let's look at Section 5, Wall Street's verdict on PWR, price versus value. When you look at Wall Street's price targets for Quanta, there is a massive divergence. I mean, on one hand, you have a low target sitting way down at $420. On the other hand, the most optimistic high target stretches all the way up to $940. The median target sits right around $800. This extreme $420 to $940 spread perfectly mirrors the tension between utilizing a strict Benjamin Graham intrinsic value calculation, which demands a high margin of safety and yields that lower target, versus a highly optimistic DCF model pricing in aggressive perpetual growth to hit that high target.
So let's break it down. The bull case is built on undeniable, immense momentum, massive AI and renewable tailwinds, a 9-year EPS growth record, and that fortified $48.5 billion backlog. But the bear case? That is purely about the price tag. The stock has been trading at an ultra-premium valuation, with trailing price-to-earnings multiples noted in the 90s. Synthesizing our guru lenses here, a 92x trailing PE immediately disqualifies the stock under Benjamin Graham's strict requirement for a moderate PE ratio. Under Peter Lynch's lens, even with massive double-digit growth, a PE this high likely results in a PEG ratio well over 1.0, making it very hard to justify as a traditional value play.
So it all comes down to this central valuation puzzle. Can Quanta justify its premium multiple? It essentially requires flawless execution. Warren Buffett would absolutely love the management team, the undeniable execution, and that ever-widening economic moat. Peter Lynch would definitely applaud the staggering top-line growth. However, Benjamin Graham would completely balk at the current price tag without a sufficient margin of safety. It's a tremendous underlying business, but at these valuation levels, the DCF sensitivity tables require years of absolute perfection to justify a buy. For value investors, this synthesis likely points to a hold until that margin of safety improves, while growth investors might just continue riding the momentum. The real question is, which camp are you in? Thank you for joining me for this explainer, and keep learning.